Because in 30 years, I've done nothing but collect information, knowledge, and your secrets.
How the stock market manipulates or tricks us into selling our own shares. Well, hello, family and friends, on this beautiful day that has been given to us. Cheers, Grandpa Haven. And family and friends, I'm back with another episode of the psychology of the stock market. And as long-term investors, even future traders, this is a video you may want to stick around to watch. I'm going to provide a basic introduction on the business cycle of the market makers and how they may use some questionable tactics into manipulating us into selling our own shares, knowing we were right in the beginning. So family and friends, class in session. You know I don't like to waste your time, so let's jump right into the video.
Into a bit of Trump gave it away to a man with too much power. You could call this in your sleep. First they'll smile, be warm, sympathetic, on your side, letting you know that they will fight for you. They will lull you into a false sense of security. And then, once your belly is exposed, they will gut you and everyone you know. And they will be swift about it. And by the time you realize you should be fighting back, well, you're already bleeding to death. Whose victory do you think they will fight for? Whose body do you think they will bear? You and I both know that he is not in charge. He is never in charge. Power is in charge. Power is in charge.
I'm going to share a secret to better understand how money flows through the market. Because once you understand liquidity, you may begin looking at charts very differently. So once again, welcome back, future angel investors. Today, we're going to talk about something that frustrates almost every investor and trader at some point in their journey. Now, before we dive into this lesson, we need to know the major players in the market are the market makers. Now, even though there is just not one single market maker, I like to affectionately call them Mr. Market or Smart Money. Mr. Market's job is to help connect buyers and sellers through your broker. And in situations where there are not enough buyers or sellers participating, Mr. Market may temporarily step in using their own capital and inventory to help keep the market running smoothly. As a business, their objective is to generate profits through buying, selling, positioning, and managing risk. And we are considered retail investors. Individually, retail investors are a very small part of the market and cannot influence the overall direction of the market. However, collectively, retail investors are extremely important to the market because we provide liquidity. So let me ask you a question. Have you ever bought a stock and almost immediately watched the price dip down or stop you out, and then suddenly reverse and move exactly in the direction you thought it would be in the first place? Since these market makers are willing to provide liquidity in the market in addition to their regular business, they may sometimes hold separate portfolios. There are positions they want to own and positions they were forced to absorb temporarily while providing liquidity. For the sake of this lesson, we will call these strategic positions and temporary positions. Strategic positions are shares they're willing and want to accumulate because they believe the market may move higher over time. Matter of fact, they know for certain that the stock is going up. And temporary positions are shares they were temporarily forced to absorb while balancing buyers and sellers in the market. Now, this means sometimes they may need to reposition themselves strategically. So here's an example of positive strategic position. Let's take a look at what happens if the market maker is forced to sell their strategic positions to provide liquidity. Let's say positive news is about to come through the pipeline, something like earnings. Retail traders and smart money become aggressive buyers because they believe the stock is going higher. And guess what? They may actually be right. But what happens if there are not enough sellers available to match those buyers. Now remember, Mr. Market may temporarily use their own inventory to help fill those orders. And by doing so, their strategic folder becomes net short because they are supplying shares from their own inventory. So the question is, where and how do market makers replenish their net portfolio at a discounted price? Most beginner retail investors are taught the same thing. Buy near support, keep your stop losses tight, and cut your losses quickly. And in theory, that sounds responsible. But here's the problem. Millions of traders are learning the exact same strategy, and the market knows this. It means many traders are placing their stop losses or liquidity in the exact same area, usually just below the support line. So if the market maker wants to purchase or accumulate billions of dollars worth of shares at a cheaper price to replenish their strategic portfolio without immediately driving the stock price higher, they may manipulate the market to their advantage by driving the market down just below the obvious support levels, because that's where many stop losses are sitting, whether it's mentally or physically. So they may intentionally drive the market down and trigger sell orders. Some people sell because emotionally they cannot bear seeing the loss and simply want the pain to stop. Others may simply follow discipline, risk management, and cut their losses according to the plan. But regardless of the reason, all the selling creates liquidity. Now, let's look at this example on a chart. Imagine a large institution wants to build a massive position at a discounted or fair market value. For this example, let's say $15 billion worth of shares. Now, future investors, they cannot simply buy very large blocks of stocks without causing attention or price to explode upward. Why? Because large volume buying pressure pushes prices higher. And if prices rises too quickly, they might not get the shares they actually want at the prices that they want. So what may happen? The institution may begin accumulating slowly. This is called the accumulation phase. So maybe they collect $8 billion worth of shares, but now they need more liquidity, but prices are moving upward. Where might that liquidity exist? Right below obvious support levels, where many stop losses are sitting. So prices may temporarily move lower multiple times, triggering another wave of fear, another wave of stop losses, and another round of emotional selling. All of that creates additional liquidity. Now, the institutions can continue building the rest of their position. And once enough shares have been accumulated, price may finally begin moving upward aggressively. Now, does this happen every single time? Absolutely not. But understanding this concept helps explain why prices sometimes stalls or dips below strong support zones multiple times before making a larger move higher. And for many traders, especially beginners, this creates frustration. Now, future investors, this is where many retail traders and investors become emotional. The market maker needs to do whatever they need to do, including manipulating the market. And that means driving the market towards liquidity. And family and friends, this is the secret sauce to why the market may move down, even though its true intention is to move higher. Because once you understand liquidity, you stop taking every move personally. Now this lesson was not designed to scare you. It was designed to prepare you, to help you understand how smart money moves, so that you can begin thinking more strategically yourself. Large money often thinks differently than emotional money. When the crowd becomes overly fearful, smart money may quietly begin accumulating. And when the crowd becomes overly excited, smart money may begin exiting their position. This is why emotional discipline matters so much. The market does not care about our emotions. The market responds to order flow, liquidity, and participation. All right, family and friends, let us know in the comments. Have you ever been stopped out of a trade only to watch the stock reverse right afterward? And did this lesson help you better understand why it may happen? Yeah, family and friends, so I hope you enjoyed today's lesson. Just think of me and the stock market sisters as the Cat Williams for beginner investors.
Because in 30 years, I've done nothing but collect information, knowledge, and your secrets.
In our videos, we're learning to be patient, disciplined, and informed investors. So with that said, family and friends, you know I love you, and there's nothing you can do about it. Class dismissed. Till next time.